When interest rates rise, bond prices fall. A bank can buy one of the safest bonds in the world and still show a major loss. The borrower did not default. Every payment remains scheduled, and yet the bond may suddenly be worth far less. The reason is interest rate risk. Start with the basic contract. A bond has a face value, a coupon payment, and a maturity date. The borrower promises periodic interest payments and returns the face value when the bond matures. The coupon is calculated from face value, not the bond's changing market price. Imagine buying a $1,000 10-year bond with a 2% annual coupon. It pays $20 each year. At the end of year 10, you receive the final $20 payment plus your $1,000 principal. If you hold that bond until maturity and the borrower pays as promised, the cash flows are predictable. Nothing about those scheduled payments changes merely because market interest rates move. The market price can change without rewriting the underlying contract. Now suppose market interest rates rise from 2% to 5%. Newly issued $1,000 bonds can now pay $50 per year instead of $20. The old bond still pays only $20. The new bond pays $50. If both cost $1,000 and carry similar risk, investors will naturally choose the new bond. That does not make the old bond worthless. It means the old bond must become cheaper before another investor will accept its smaller payments. Its market price might fall from $1,000 to around $850, depending on its remaining maturity and the size of the rate change. A longer remaining maturity would usually require a larger adjustment. The payment stayed fixed, the price adjusted. This creates the central bond market relationship. When market rates and required yields rise, existing bond prices fall. When required yields fall, existing bond prices rise. This is why price and yield charts normally move in opposite directions. At a lower purchase price, the same $20 coupon produces a higher return relative to what the new buyer paid. Yield to maturity also includes the eventual return of principal, so professional bond pricing uses every remaining cash flow. Each future payment is discounted back to its value today. The relationship also works in reverse. If new bonds pay only 1%, an older bond paying 2% becomes more attractive, and investors may pay more than face value for it. But not every bond reacts equally. Duration estimates how sensitive a bond's price is to changes in rates. Longer maturities and smaller coupon payments generally create more duration risk. Duration is measured in years but also functions as a practical sensitivity tool. A bond maturing next year locks you into an outdated rate briefly. A 10-year bond locks in those smaller payments for much longer, so investors demand a larger price discount. For illustration, a 1 percentage point rate increase might reduce a short-duration bond by roughly 1%, but reduce a longer duration bond by 8%. Exact results depend on the bond structure. If an institution bought a bond for $1,000 and its market value falls to $850, it has an unrealized loss. The loss exists on paper, but the bond has not been sold. Accounting treatment may differ, but the economic value still changed. If the borrower remains solvent and the owner can hold to maturity, it may continue receiving coupons and eventually recover the full face value. That does not erase opportunity cost, but it can avoid selling below face value. Selling early changes everything. A sale at $850 turns the $150 paper loss into a realized loss that directly reduces the owner's financial position. Banks often hold government bonds and mortgage-backed securities for income and liquidity. These assets may carry little default risk while still carrying substantial interest rate and duration risk. The same basic risk also appears in pensions, insurers, and ordinary bond portfolios. If depositors suddenly withdraw large amounts, a bank needs cash immediately. It may be forced to sell underwater bonds, realize losses, weaken its capital, and create even more concern among depositors. The takeaway is simple. Low default risk does not mean no price risk. Rates up usually means existing bond prices down. Longer duration means greater sensitivity, and a temporary paper loss becomes dangerous when the owner needs cash before maturity. That's your finance fix.